When you deposit money into a checking account, you aren't storing it in a vault. You are lending it to the bank. Banks operate on fractional reserves. Their core business model relies on taking that borrowed money, holding only a fraction of it in reserve, and selling the rest of it to other borrowers at a higher rate. Look at a standard corporate balance sheet. Cash and inventory are assets. Debt is a liability. For a bank, those definitions flip completely. The cash you deposit is the bank's primary liability. The loans they issue to homebuyers or corporations are their primary assets. Because of this inverted structure, applying standard corporate logic to a bank will lead you to the wrong conclusions. To actually measure systemic risk, we have to look at the strict mechanics of how these specific assets and liabilities interact. The most precise way to measure a bank's financial stability and its legal constraints is to deconstruct its statement of condition and income statement line by line. We will build a model institution, Protobank N.A. It's a typical commercial national bank holding exactly $10 billion in total assets. Protobank is required by law to prepare these financial statements, known as call reports, for regulators and the public. These aren't optional disclosures. They are heavily scrutinized by the Office of the Comptroller of the Currency, the Federal Reserve, and the Federal Deposit Insurance Corporation. For investors, creditors, and regulatory lawyers, these documents serve as forward-looking survival tools, revealing exactly how much stress the institution can endure before it breaks. Let's construct the left side of Protobank's balance sheet. The foundation is the primary liquidity reserve. A block of $0.8 billion in cash and due from banks drops into the base. This cash sits in vaults or on deposit with the Federal Reserve to cover immediate obligations. Historically, all depository institutions had to maintain a strict fractional reserve percentage. But in 2020, the Federal Reserve determined the system had ample liquidity and reduced this reserve requirement to zero. Next, Protobank adds a $2.2 billion block of investments to serve as a secondary liquidity reserve. With very few exceptions, banking regulations restrict these investments to easily marketable debt instruments, like federal or municipal bonds. They are rarely corporate stock or other equity investments. The bank divides this portfolio into two accounting categories. Instruments labeled held to maturity use flexible book valuation, while those labeled available for sale must be marked to their current market price on an ongoing basis. This chart shows the percentage of unrealized losses on both held to maturity and available for sale securities across the banking sector. Notice the sharp downward spike beginning in 2022. As interest rates rose rapidly, the market value of older, lower-yielding bonds plummeted. This reveals a critical vulnerability. Government debt has virtually zero default risk, but if a bank is hit by a sudden wave of deposit withdrawals and is forced to sell those bonds before maturity, those paper losses become realized losses, actively destroying the bank's cash position. Now we reach the bank's core business. A massive $6.65 billion block of gross loans stacks on top, bringing our asset column near its $10 billion ceiling. Unlike bonds, loans are illiquid, one-of-a-kind agreements between the bank and borrowers. Mathematically, a certain percentage of these borrowers will default. Regulators require banks to estimate these future defaults using a strict accounting method called current expected credit losses. Based on economic conditions and credit quality, the bank sets aside a specific reserve called the Allowance for Loan and Lease Losses, or ALLL. This allowance is carved directly out of the gross loan block on the balance sheet. For Protobank, a $150 million deduction leaves us with a true net loan figure of $6.5 billion. To see where the money for that allowance actually comes from, we have to pull up the income statement. When a loan actually fails, the bank charges that loss against the allowance. To replenish the allowance back to regulatory minimums, the bank must deduct a specific amount, in this case, $25 million, directly from its operating income. This deduction is the provision for loan and lease losses. The allowance creates a mechanical bridge between the balance sheet and the income statement. Expected future risk directly reduces the bank's reported profit today. We can now build the right side of the balance sheet. Deposits are the bank's principal liability and its main source of operating funds. We start by stacking $2 billion in demand deposits and $1.4 billion in now accounts. These are transaction accounts, meaning customers can withdraw funds immediately for payments. Non-transaction accounts, like savings and certificates of deposit, restrict immediate access, but usually pay higher interest to the customer. Adding those savings accounts brings total deposits to $8.2 billion. Throw in another billion for short-term borrowing and trading liabilities, and our total liability stack reaches $9.2 billion. Notice the visual gap between our assets and our liabilities. The relationship between these two columns dictates how the bank makes money. On the income statement, Protobank earned $640 million in interest from its assets and paid out $190 million in interest on its deposit and borrowing liabilities. The difference between the average rate earned on loans and the average rate paid on deposits is the net interest margin. That margin is the bank's core profit engine. If it is too narrow, the bank won't generate enough income to cover the risk provisions required, and it will slowly bleed out. The final $800 million block fills that gap on the right. This is capital, or net worth. It is the mathematical difference between the bank's $10 billion in assets and its $9.2 billion in liabilities. These funds come directly from shareholders and retained earnings. Capital serves as a shock absorber. If the bank's assets lose value, the capital block shrinks to absorb the blow, protecting the depositors and the FDIC insurance fund. But look at the scale. Protobank's capital is extremely small relative to its size. It holds just 8% of its total assets and equity. If a wave of bad loans or a sudden forced sale of bonds causes the asset column to shrink by exactly 8%, the entire capital cushion is crushed. The bank is mathematically insolvent because its liabilities now exceed its remaining assets. Because the margin for error is so thin, maintaining this capital cushion is a strict legal mandate. Falling below regulatory thresholds triggers immediate enforcement actions, dividend restrictions, and ultimately seizure. To control this fragility, regulators monitor institutions using the CAMELS rating system and enforce strict minimum capital ratios established by the Basel III framework. Applying a flat capital requirement across the board is inadequate. $1 million in cash carries a vastly different probability of default than $1 million in commercial real estate loans. Regulators do not just measure capital against total book assets, they measure it against risk-weighted assets. Under the standardized approach in Regulation Q, every single asset on the balance sheet is sorted into different paths based on risk. Cash and government bonds receive a 0% risk weight. Claims on other banks receive a 20% weight, while residential mortgages often carry a 50% weight. The framework is so comprehensive that even off-balance sheet items, like unused lines of credit or standby letters of credit, must be mathematically converted and assigned a risk weight, forcing the bank to hold capital against contingencies that haven't even happened yet. A bank's financial statements act as real-time, heavily regulated topographical maps of systemic risk. Every line item dictates the precise amount of leverage the institution can deploy and determines what it is legally permitted to do in the global economy.